to the Fibonacci group. Well, first of all, who or what is a Fibonacci? Simply put, the Fibonacci numbers are patterns that we humans interpret as beauty. The stars, the flowers, and even the pyramids. The Fibonacci group helps others create an enriching lifestyle from the patterns and equations of multifamily investments. These investments are great for receiving higher than market returns, recession-proof investing, and a simple way to create compounding generational wealth. With multifamily investment, you are able to defer the taxable income, receive real estate depreciation credit, and still yield a quarterly dividend. So many have asked, why multifamily investing? Our answer has always been, why the heck not? Want to learn more about multifamily investing? Subscribe for more videos. Check the website out, or just give us a call.
Okay, so that is a 60-second version of who we are, what we do, why we do it. So back to the disclaimers. I am not an attorney, not a lawyer. This is not an offering memorandum or private placement memorandum. What that means is an offering memorandum is something that is provided to an individual when they are selling a property. The private placement memorandum, it is what is provided to individuals or investors when a property is being purchased through the securities. I'm also not a CPA, and everything that I speak about in this video is for educational purposes only. So the reason why I say that, and I'll go a little bit more in depth later, but the reason why I say that is because when you are dealing with these type of investments, you are dealing with securities. Whenever you have an investment that you do not have control over, you are what's called a passive investor, and or you are buying a share into another company, you are now dealing in securities. So everything that I say, please talk to your lawyer, your attorney, same thing. Talk to your CPA and make sure that either the language that I'm going to be giving applies to you or does not apply to you. Does that make sense? Let me see if there's a way I can see hands on here. Where's my screen where I can see my people's? There it goes, right here. So I just want to make sure you guys can see me. Everything is going good. One more time. This is going to be the last time. Somebody give me a wave. You guys saw the commercial and you heard my disclaimers. Good. Thank you, thank you, thank you. All right. So now let's proceed with the presentation. This is not the full presentation. After we finish with this this Zoom call, if you guys want the full presentation, shoot me an email, text, whatever. I think most of you guys have my information, and it would also be at the end of the presentation as well. I am going to very, very quickly go into who I am and a little bit of my background. I think that is important, especially when you are potentially giving your money to someone or to a business, to know their character and know a little bit about their background. So real quick, I was born in Houston. I was born into real estate, and I was also born into multifamily. Very, very young age, my grandmother owned 2 apartment buildings, and pretty much since I could walk and talk, I was doing make ready, getting the units ready for new tenants. And as you can see here, I started learning how to renovate homes and multifamilies. I think I was actually 8 in this video, but I've been doing this and in this for a really long time. I got my pilot's license at 7, and my objective then, when I was in high school, was to actually get a degree in aeronautical engineering, but I couldn't leave real estate. So I went to college for a little bit and actually left college and started brokering mortgage notes and other type of notes. Moved back to Houston in 2010, and when I came to Houston, I brought this company. This company was an auto enthusiast club that I started. These were a handful of clients that I've had when I was operating that business. And at the top left of the corner, that is an event I did with the Lamborghini Festival. There, I met a gentleman. We started another company dealing with renewable energies. And interestingly enough, even though it was with renewable energies, it was a partnership and a collaboration between the renewable energies field and also design, which is why we went to Italy and spoke with and had a exhibition with Bugatti. We spoke with some of the family members of Lamborghini, and it was a fun trip, but it was very interesting, the type of investments and ideas that people have. Came back, this trip was only, I think, a week or two, but came back to the States a little bit later. I think this was about a year later, and my wife and I opened up a mental health clinic. We do mostly virtual now for obvious reasons, but this was the clinic that we had in the Woodlands. We still operate the service, and brings us to what we are here to talk about, which is the Fibonacci Group. The Fibonacci Group is a group of individuals, me, a CPA. We have a security exchange attorney, which is also one of the partners. He was scheduled to be on. He's not feeling well. He might jump on for a minute, but I don't think he's going to be able to make it. You'll see his information here shortly. Our mission is to provide a vehicle that produces high returns and consistent cash flow. That is the intent and intentions of all investors, but we specifically look for a vehicle that will produce high returns, and that is how we got into multifamily. That, and it's kind of been in my blood since an early age. So the objective of the Fibonacci Group is to present a strong investments to its clients, which is you. You will hear me interchange apartments with multifamily. Apartments is more of the layman's term. Multifamily is a little bit more investor language, but they're the same thing. An apartment is a multifamily. A multifamily can be an apartment. Depends who you're talking to, and it depends if you're talking about a group of townhomes and other investments, then the wording can, maybe not always be interchangeable. But for this intents purposes, apartments are multifamily. The reason why we chose multifamily is because it is the safest investment that you can partake in. Well, let me say this, because my lawyer's not here to keep me out of trouble. It is one of the safest investment vehicles that you can invest in. It is predictable. The reason why it's predictable is because when you're buying an apartment building, it's been there for at least a couple years, typically. The properties that we look at are typically 10 years or older. So that means it has a track record. So this presentation was made for the experienced investor who has been doing this for years. They're accredited. They understand the language. They understand the market. They understand what's going on and the intricacies of what they're dealing with. It has also been written for your grandmother, or your aunt, or your dad, or your uncle, or your husband or wife. I made this presentation so anyone who reads it will be able to understand what we're talking about. So I'm going to go read it real quick. The presentation guide will provide a very basic overview of the investments our fund is seeking. At the completion of this guide, you will have a fair understanding of the terms, returns, and the team used to initiate and sell the investment security. Remember, keep this in the back of your mind. We are dealing with securities. Information presented was created for both the accredited and blue collar investor and has been intentionally worded accordingly. And I've already went over the offering memorandum and private placement memorandum. So lead partner, me, Melvin is our security exchange attorney. He makes sure that we are not entering into any money laundering violations. It is a slew of guidelines and laws and recommendations. You have to have a SEC attorney as well as a real estate attorney when you are dealing with multifamily properties. Melvin is the principal attorney at the Furby Group. He is in Houston. He is from Virginia, and he has his Bachelor of Arts in Government from the College of William and Mary. I'll skip down to the bottom. Melvin represents a broad base of clients in complex corporate and securities law transactions, real estate transactions, mergers, and acquisitions. Melvin is, as I said earlier, also a partner. He brings not only a wealth of knowledge, he brings a lot of resources from inside as well as outside of the, not even just the real estate space. We have been looking at or receiving resources from the entertainment district to banking, investment vehicles to either meet those investors or bring those investors into our space. So he is a huge blessing to our company. Pierre is our current CPA. Pierre actually has been recently featured in Forbes, which is really cool. And as you can see, Bloomberg Tax, Law 360, America's Voice News, and Spectrum News in Austin. He comes with a lot of credentials and a lot of referrals. The CPA, when you're dealing with these securities and investments, and after this, I'll be able to break it down a little bit more of the apartment or multifamily investing. But the reason why a CPA is so important is not only just so you can make sure the numbers are right. If you are buying an apartment, let's say the apartment is $10 million and you have a group of investors, let's say it's 200. Well, the CPA is the person who gets together your checks monthly, because our goal is to give out dividends monthly, and he sends you the checks. He not only gets together the Schedule Ks for the investment. The CPA is one of the most important roles when you're dealing with multifamily investing, and I'm glad to have Pierre as the gentleman helping us do that. All right, so let's go into what we're actually doing and why you're on this call. So this is the process, and it is not necessarily in this order for different reasons. What we are doing right now is a type of generating financial interest. The second is to analyze the offering memorandum, and I'm gonna stop there. The offering memorandum, remember, is something that usually a broker will put together. It's usually a brochure, and it's explaining to the potential buyers of why you want to buy this property, the area that it is located in, the city, the demographic, the income for that particular area. Sometimes you will get an offering memorandum first, but you're always trying to generate financial interest. The reason why they are not necessarily one goes before the other is you always want to have money available to buy the property. So you can get properties all day long, but if you don't have the monies available and the resources available to buy it, you're going to miss a deal. The second or third step is to submit an offer. And I put here, there are many steps before this point. Before submitting an offer, there can be weeks of analyzation or underwriting and weeks of due diligence. Let me say now, even through COVID, even through this pandemic that we're going through, the market is ridiculously hot. To give you an understanding, 2016, 2012, any time before 2017, you would get a deal, you would talk to the broker, and you would say, hey, I want to put a letter of intent, meaning I want to send you a letter saying that I want to buy this property. And then you would get about 30 days to do your due diligence. You would make sure that the financial statements that you receive from the broker is correct, they're accurate. You would get to see the shape of the property. You want to see who your tenants are, and we'll go into that a little bit further. But you'll have a couple weeks to 30 days to do your homework. After that 30 days, your earnest money, your deposit, will be non-refundable. For the last 2 years, minimum, once you submit your letter of intent and you enter into your purchase sale agreement, and let me pause there, your deposit is typically 1% of the purchase price. 1%, right? So if you're looking at a property that is $10 million, you're putting up $100,000. Okay, and let's go backwards. You submit a letter of intent. That letter of intent typically goes to a purchase agreement if the broker and the seller agree with your terms, and your earnest money or your deposit is non-refundable day one. That means you have to have your act together. So you want to do as much research as possible. If it's a bigger deal, so usually anything over, let's say 150 units or higher, they're going to do offers, call for offers, which is usually the first one, and then they'll do typically 3 rounds of bidding. So even though you submitted your letter of intent, even though the seller says that they agree with your price, you're still going to have to bid on it. Now, after you bid on it, you still have a little bit of time. I'm sorry, let me correct that. After you have won the bid, you still have a little bit of time to close on a deal. If you are doing a conventional loan, it could take up to a year to close on that loan. It takes a really long time if you're doing it conventionally. If you're doing private lending, which basically means going through a bank, sometimes a smaller bank or a credit union, you'll typically have 60 to 90 days. And that could be a deal breaker. The seller could say, hey, I need to close this deal in 60 days. I don't have a year to see if you're going to get funding conventionally. And that might, even though you have the higher price, that might knock your bid out, and you might lose that. The last part is to close and initiate investment plan. That basically means, and I have further slides that go into a little bit more detail, but the basic idea of what we're doing is just like you flip a home, we're flipping apartment buildings. The difference is when you flip a home, you typically want to keep the home for maybe a month, sometimes 2 months, renovate it, and then put it back on the market, and hopefully get out of it within 3 months total or 4 months total from your buy, renovate, and then sell. With multifamily, you're buying, you're renovating the units, and you're selling at minimum of 3 years. The average is 5 years. And then if you're doing an extended flip, it could be anywhere from 7 years to 10 years, which is very common. The most common is 5 years. A few reasons why investors do that. One, the tax laws. It is more beneficial to hold a property for more than 3 years. And actually, I think the threshold is 1 or 2. And then it also helps with your returns. You get higher returns, and then you're also able to write off more um, tax credit if you keep it longer. All right, so next slide. My favorite part, why Fibonacci, why multifamily investing versus the traditional stocks and retirement? With multifamily, you can depreciate, just like rental homes, you can depreciate that property. You cannot depreciate stock, and stock and retirement are similar, because when you are putting money into your retirement, sometimes the retirement plan will be in certain stocks. So a lot of those things are similar. But if you are investing in stock, you will get a quarterly dividend. Whatever gains you get in retirement kind of just stays in that account, right? You don't get a check for that, because that's the whole reason why you're doing it, is to save for retirement. Stock can be volatile. So if you buy, let's say Apple, I don't look at stock. I don't know what stock prices are, but let's say Apple today is $100. Tomorrow morning it could be 50, and then the next day it could be 150. Now I know Apple specifically is not that volatile of a stock, but in general you can have really good stocks that will go from 0 to 100 in a matter of minutes or hours or days, depending on what's going on in that company, or what the market is doing. Apartments are not volatile. They have higher returns than stock, but there is no mechanism that will say, hey, you bought this property for $1 million. Tomorrow's going to be worth $5 million. And then the day after that, it dropped back down to 3. Real estate moves a lot slower than stock, but it's also more predictable. The next thing is the income tax benefits. I don't want to go too much in depth in that, because I have another slide that breaks that down a little bit more. Predictable market. When you buy an apartment, tenants typically stay in an apartment for at least a year. So when you are purchasing an apartment, when you're purchasing a multifamily, the lender that provides the debt asks for 12 months. When you're dealing with stock, you can look at the historical highs and lows and the technical markets to kind of understand that stock specifically. But if the CEO resigns, that could drop the stock in a matter of minutes. I went over the whole period for multifamily. 1 year is plausible. It's not typical. 3 years is the minimum for the most part. And then 5 years is usually the average. But when you're dealing with stock, unless you're a day trader, but if you're investing in stock, it could be up to 20 years. Now it's typically, maybe 5-10 years, and it depends on what your trading strategy is. But long-term trading is typically 5 to 10 years plus, unless you're a day trader, or unless that is maybe, I don't want to say a side hustle, but something that you try to get a return out of a little faster than what the market over time will allow. Retirement depends on whenever you start putting into your retirement, but it's basically up until the age where you're ready to pull out. Or if you have an event, you have, I don't want to say struggling with the home, but you have an emergency in your household and you need help paying the mortgage, or you've had some crises that your retirement account allows you to pull out for. I think also birth of a child might be one, but don't quote me. All right, so recession resistant. This is um, the figure that goes through the last couple of recessions. And as you can see, the rent steady increased even through the 2007 2008. It dipped a little bit, but it still for the most part rose. Now your question is, now how is real estate doing, how is multifamily doing right now through COVID? To be honest, it's kind of unclear. The reason is, first, it depends on what class of apartment you have. If you have a class A, class B, or class C, which I'll go to in the next slide or two, the income and the income demographic determines whether they're exiting or cannot pay for that apartment. The people who are mostly losing their jobs are low income earners. It's the people who work at the hotels, it's the people who worked at the movie theaters, it's the waiter and waitresses. Those are the population and the income of people who are hit the hardest. So if your property, if your apartment investment that you have is more catered to the lower income, you're going to be hit a little bit harder than someone who, well, they are an executive or they're a high income earner for a corporation and they just went from going into work every day to just having Zoom calls and continuing work like normal. So it's really dependent on where you are in the country. Houston has a very strong um, economy in general. Texas in general is where we look to buy. We will buy anything in what's called the Sunshine Belt, but we like to focus Texas because it's close and it's easier to drive to a property while the property is being renovated and to implement your business plan. And if you guys have any questions about the recession resistant part, let me know after, because remember, we're going to have a question and answer at the end. Real quick, this is Mr. Harvey. If you guys have ever heard of the inverted yield curve that predicts the recession, this is the guy who came up with that concept. No one really knows what's going on. Many people have predicted that we will go into a recession, that we should be in a recession, that we're already in a recession. Some markets indicate that, and then some don't. The stock should not be doing as well as it's doing, but it's doing well. So whether we're in a recession, whether you agree with that, whether you have a degree in, if you're an economist or not, the picture is not really clear because we're in a state that we've never been before. But even in saying that, apartments is still one of the safest, if not the safest investment that you can put your money in. Your apartment value is not going to go to zero tomorrow. Other investments can. Hotels are definitely not doing well right now. Retail is actually, I just read a report yesterday, retail is actually doing okay, believe it or not. And I think it's because the country has opened back up. They might shut it down again, so retail might drop. Industrial is doing okay, but multifamily will continue to be one of the strongest, safest investments out there. All right. So we have two options when we invest. The first option is a buy and hold. Basically, that is buying a property that does not necessarily need to be renovated, but it provides a really good return. So you hold it because it's giving you a return. It's not giving you a 20% jump in price, but it's giving you maybe a 30% internal rate of return, or IRR, or the cash on cash is really, really high. What the Fibonacci group focuses on is the value add. The value add, like I explained earlier, is buying a property, switching out the appliances to stainless steel, switching out the countertops to granite, putting in vinyl flooring, making the apartment and bringing that apartment to what they call top of market. So that way you can increase rent and then therefore you can add more value to the apartment. So both are options. Option one is actually what a lot of insurance companies do. So insurance companies actually will buy property so they can have a consistent return for their investments. The minimum return is a very fluid and is very deal dependent. So if you see here, it says the equity multiple minimum is 1.5, which is good. Not great, but good. The IRR or internal rate of return is 10%. That's not good. Cash on cash or COC is also not good. But the reason why this is in here is, as you can see at the bottom, IRR and the COC can be inversely related. You can have a really high, so we have a deal now, and the IRR is close to 30%, but the cash on cash is roughly 14%. You might have a deal where the cash on cash is high, but the IRR is really low. So this is just a basic guideline of what we'll look for in a deal, what we will not go below. No matter how big the cash on cash is, if the IRR really is lower than 12%, is probably what we're looking at nowadays. If it's lower than 12%, we won't even look at it. Cap rate is has also changed in Houston, and it's changed probably a year ago. Again, for multifamily, cap rate is, or the definition of cap rate is the percentage of return for a property if you pay cash. The higher that cap rate number, typically the worse the property is. So being realistic, if you were to buy a property in Houston at 8%, if it was an 8% cap rate, it will be a Class C property, very, very, very low income. Not saying that it won't make money. Obviously, you're getting a higher return for it, but it's a lot riskier. If you are looking for something, let's say in the Galleria area, for the people that I have on here from Houston, the Galleria area, River Oaks, everybody make sure your microphone is on mute. I got feedback. I think it's Ivana.
Oh, sorry.
Thanks. And thanks for joining too. I appreciate it. If you're in the Galleria area, your cap rate will be, depending on where in the Galleria, but your cap rate will be probably 5%. It could be a little bit more on 5 to 6 or 4 to 5%, but you're going to be somewhere around 5%, which means you have a lower return, but it's a lot more stable. So when you get this presentation, or if you go back and look at it, I'm recording. If you go back and look at it, these minimal returns is not the exact number for every single column. So we won't look at a property that has a multiple of 1.5, an IRR of 10%, and a cash on cash of 8%. Cap rate is just, it's determined by the property location. All right, let's keep going. Uh-oh. This is an example of, hope you guys can see my arrow here, but this is an example. If you invested $100,000 into a deal, and then I'll really quickly go down the road here, but investing $100,000, you have a preferred equity and a preferred equity split, typically called the split. Preferred equity is the first percentage of cash flow or return from the property. So this property right now, actually I just have after it's been renovated, but the cash flow would be 287,000. And this is after it's been renovated, but just to give you an idea of what the split means. So off of 287,000, the investor or investors that got the preferred equity will get 8% off that. Then after that's been taken out, the syndicator, which is the Fibonacci group, will get 25% or 20 or whatever the split is. In this case, it's 25%. And the investor group will get the other 75%. This property is valued at 8 million, 1.6 million down to acquire the property. And we said it will cost $350,000 to renovate the property, all right? The ending loan amount would be roughly 6.7, and then we did a cap rate of 8%. The rest of these numbers down here are pretty much self-explanatory, except NOI. NOI is net operating income. NOI, rule of thumb, is 50% or half of your gross income. That means when we're looking at a property and we're looking at the net operating income and it is more than 50%, that immediately tells us this property is not being managed well, which means it could be an opportunity for us. So once we look into the financials, maybe they're paying the property management group too much. Maybe they have not instituted what's called water conservation, which is what it sounds like. You're trying to save water. It's different things that you can do on a property, and it's different things that you should do on a property to make sure that your expenses are around 50%. You want to have your expenses as absolutely low as possible without getting over on a tenant. You know, you want to provide a good asset. You want to provide a good place to live for people, but you also want to make sure that your property is running efficiently as possible. All right, back to the numbers. Holding this for 3 years, the current rent being $1,066. So we take each unit, it's 100 units. We put in 350. We raise the rent to $1,385. The way that you get a value from this property is simply crazy, which I wish I'd have put in here. It might be on the next slide. But the equation basically is the value of your property is only the NOI, whatever that NOI is, divided by the cap rate, which in this case is 8%. The cap rate is determined by usually the area of the property and some other metrics. The NOI is not something you negotiate. It is what it is. If the property is making $100,000 a year, it's making $100,000 a year. Now, when you take it over, it might be a different number, but when you're purchasing a property, it is what it is. What you negotiate is the cap rate. Sir or broker, ma'am, I don't agree with your cap rate of 8%. I believe it is more 7.3 or whatever, you know, you and your team, or I guess in this case, our team evaluates it to be. But basically this number here, this NOI divided by this cap rate is what equals that sell amount. Broken down here, this investor gave $100,000. From that 8% preferred equity, they received a total of $3,800. The 75% of the equity split yielded them $33,000. And then when we sold the building, they got another $299,000 from the sale of the building. And then their total return was $409,767. All right. This is why multifamily, this is actually just one of the reasons why multifamily is amazing. You put in 100, you got 400 back. So you almost made, you made 100 and over $100,000 a year for 3 years, and you got back $400,000 or over $400,000. This is the definition of an accredited investor. All right. So for one person needs to have an income over 200,000. If you are married, then you need to have an income of 300,000. But you also need to be expecting and show reasonable expectation of receiving that same income every year. You can't win a lottery for 200,000 and say, "Hey, I'm an accredited investor," unless it was for a couple million. And then the second part says any natural person whose individual net worth or joint net worth with that person's spouse exceeds $1 million. So if you win a lottery, it just needs to be for a couple million. There are other definitions of being an accredited investor. You can go to the irs.gov and they will give you further definitions. The reason why knowing if you're accredited or not accredited is very important is because remember, we're dealing with securities. Everything we do has to be followed by the letter of the law. So there are two types of offerings that the Fibonacci group deals with. There is a regulation 506D. I'm sorry, in the D regulation is a B raise, B as in boy. And then there is a 506 C as in Charlie raise. A B as in boy raise says from the IRS and the Security Exchange Commission that you can only have 35 people who are non-accredited. That means they do not make over $200,000 a year. They don't have $1 million in net worth. They are an average American who maybe has some savings or retirement that they want to have access to invest. That is 506B as in boy raised. So 35 non-accredited. You can have as many accredited as you want to, but you can only have 35 non-accredited. With those 35 non-accredited investors, you also cannot do general solicitation. So I cannot put anything on Facebook, Instagram. I can't create flyers. I cannot tell the mass audience of my local city, state, whatever, that I have an offering for sale. It is illegal unless I am doing the 506 C as in Charlie. Now that definition is only accredited investors. You can do a general solicitation. I could put something on Facebook. So if you ever see a property on Facebook, a commercial property, and they are looking for investors, that means that they are only looking for, they can only accept accredited investors by law. If you see someone doing otherwise, or if they allow you into the investment and you are not accredited and they are doing a mass solicitation, be careful, talk to your attorney. It is illegal as far as the IRS goes. All right, next slide. Most of the individuals on this call are familiar with the different classes of multifamily, but I'll just really quickly give you a description. Class A is usually really new, less than 10 years old. It's usually in a really, really nice area. We all have a picture that comes into mind when we think of Class A. Usually Galleria, Hughes Landing in the Woodlands, something really, really nice. A lot of times in Houston, it'll have some kind of valet service and a lot of amenities. Class B can be really nice or decent. They are 10 years plus, 15 years plus, and not necessarily predicated on how new they are, but it's what do they provide. So these are typically 1 story, 2 story, 3 story, garden style, which means you have the stairs, you walk up to your apartment. Sometimes they have an elevator. Most of the times they don't. But it's your really nice, 900 square feet, 1,100 square feet, 1, 2 bedroom, sometimes three, apartments that you see around Houston. Class C can be broken down into two different groups. Um, Technically, there is no Class D, but some people will say Class D because they call Class D war zone. So if you hear a property being a Class D, then you understand what they're talking about. There are nice Class Cs. Class C is typically low income, and it is typically in a low income area. Now, an amazing point is to find a Class C apartment in a Class B area, or even better, a Class A area. So you're finding an apartment where it's kind of run down, it's pretty low income, but it's right behind a Galleria. That is like the perfect investment. And then here I go into cap rates, which I went to a little bit in depth before, but basically cap rate is the return on your investment if you paid cash for the property. This gives an understanding of what a waterfall return and what a typical return may look like. Usually when you are investing in multifamilies, because the purchase price is so high, the minimum usually falls between 50,000 and 100,000. It usually does not make sense to buy a property that is under really 75 units. The reason why, it costs the same to do an appraisal on a property. You still have to pay for the same services that you do on a 10 unit as you do on a 100 unit. So why would I spend roughly the same amount of money doing my due diligence on a 10 unit, besides, the down payment? Why would I waste the same amount of time and funds and resources on a 10 unit when I can spend the same amount of time and resources on a 100 unit that is going to yield, 100 or more times the return? So there are some funds, there are some properties they're just really good deals. It's a 30 unit, it's never been renovated, it's a really, really good price. It is owned by mom and pop, which is probably someone who worked really hard their whole life. They saved up the money, they either built it or bought it 40, 50 years ago, 30 years ago. They just need to get out of it. You're getting it for pennies on the dollar, something like that, then yeah, it makes sense. And then you might have an investment call for maybe 25,000. I met with some investors a couple months ago, and they had a raise of minimum of 35,000 because it just made sense. But typically, you're 50,000 to 100,000. Most investors do not typically go over 100,000, even in the space where the property is 100 million. Most investors do not typically go over 100,000 unless they have a specific financial goal. There are stories where investors will have net worths of hundreds of millions, and for the first 3 or 4 deals, 5 deals, they'll still only put in 100, and then maybe the fifth, sixth deal they'll do 200, 300, 400, but typically most people do 100,000. Now if you want to write a check for 300, I promise I will not return it. And I will be all smiles, but typically, just to give you guys an understanding, that's what most investors do. The preferred return is not a return that is always there, depending on the deal. A return can be offered if a company needs to reach what's called a hurdle. So let's say it's a deal. The deal is $10 million. We need to put down 30%. So we need to raise $3 million. But we first need to get to $1 million. Maybe that $1 million takes care of some engineering stuff that we have to do. I can't think of the term, but basically sampling the soil. But we need to get to this $1 million first. We need to do it really fast. So what we'll do is we'll offer for those investors that are in that investment pool of $1 million, the first $1 million, we'll give them an 8% return. In this slide, an 8% return does not necessarily mean an 80-20 split. This is just an idea and an understanding of the way it works. But we might provide an 8% preferred return, which, remember, in the beginning, it means that before anybody gets paid, you get paid that 8% first. So they can be offered in a hurdle. It is not uncommon for it to be often just offered as a general return. Some groups just automatically offer a 6, 7, or 8% return to all of their investors. But when they do that, it also affects the equity split, because if the company is given 8%, the numbers still have to make sense. The cash on cash still has to be good. The internal rate of return still has to be good. And the equity multiple, just meaning how many times you multiply your money, still has to be good. So you can't give such a high preferred return to all of your investors and still give high returns everywhere else. It's give or take. Lead investor. Okay, so the lead investor, or what's commonly called as the key partner, is the person who, or group of people who have enough net worth to cover the property. A lot of times a lender will require either the group as a whole or one person or a handful of people to have enough net worth to cover that property. So you need a person who by themselves could qualify for this debt. So we'll call him Mr. Jones. Mr. Jones is been an investor his whole life. He has a net worth of 20 million. The building that we're buying is 10 million. His name goes on all the papers along with the LLC as being the person who, hypothetically, if this deal goes wrong, they can potentially look at him as the person to help pay back the loan. Now, I said potentially because depending on the type of loan that you get, commercial loans, and specifically in multifamily real estate, they have what's called non-recourse. What is absolutely amazing is you can get a loan for $20 million, default because the property is not operating correctly, or let's say maybe the whole thing burnt down and you can't get insurance money, whatever. You're not able to make your payments and the property defaults. Non-recourse means the lender will not come after you for the loan, which is crazy. This is why the rich get richer. This is also why they created bankruptcies to help wealthy individuals get out of some of the mishandlings that they run into. So that's that, and that is non-recourse. But that's what the lead investor does, or the key partner does. They are very, very, obviously, they're very important to the deal. And that's why they get a little bit more money. And actually, a lot of times, the key partner or the lead investor won't get anything more than the other investors. And it's usually because maybe they want to start doing their own deals later. You have to show experience in multifamily before a lender gives you money. You cannot read a book on how to sell multifamily. You cannot go take a class. You cannot pay for a mentorship, learn everything about buying and selling multifamily and investing in multifamily, go to, let's call him grandpa, borrow $5 million as a down payment and get a loan. The lender will not give you the loan. You have to show experience, or your team has to show experience in multifamily. They have to see that you have done a deal before. It could be, hey, I started with maybe 10 units, and since it's so small, you can usually get around that. But I started with 10 units, or I did a deal with somebody else, and our first deal was 75 units, and now I'm trying to buy 150 on my own. But you have to show experience, or have somebody with experience on your team. All returns will be confirmed in the PPM and are subject to change. The PPM is a very large loan document written by our SEC attorney, and it goes over every possible situation for gains and losses. And it basically talks about your return on your investment. Fibonacci versus stock. I won't go into this too much, but there is a difference. Stock is not bad. Stock is definitely not bad at all. I just believe multifamily is a lot better, and I have proof for it. And I think the depreciation slide is on the next slide, but you can't depreciate stock. Stock is regulated. I put on here that the SEC regulates multifamily. Obviously, stock is regulated. Stock is liquid, but it also can be very volatile. But mostly, you have tax benefits with multifamily. You have investment opportunities with multifamily. You have what's called a 1031 exchange. I will not speak on any proposed political plan for 2021 because they are proposed. They are not written into law. So it kind of defeats the purpose of saying what the president may or may not do, because it still has to be passed into law. All right, the stock investment. So basically, you put $100 million into a stock. You got a 10% return, which means your return is $100,000. But you just created what's called a taxable event, which means you have to pay taxes on that money. This investment is not speaking about dividends. That is a different tax bracket. We are talking about an exit. When you have dividends, you are not exiting the stock. We are talking about exiting stock versus exiting multifamily. So you'll have a capital gains tax on that $100,000, which means that you only got $80,000, which means you went from a 10% return to an actual 8%. You only put $80,000 into your bank account. Okay, pretty easy math. Look at what multifamily happens, or look at what happens with multifamily. There's a few different things going on here. The first thing is you can see that you have a deduction for your building, you have a deduction for your improvements, for your content. This is done by a company coming out, usually engineers, and giving you a breakdown of everything in the property, saying your carpet can depreciate to zero over 5 years. Your structural framing and the structural components of the building, the HVAC, and other components might depreciate over, let's say the structural is 15 years and the HVAC is 5. And you can depreciate that down. You can write that as a tax write-off, usually over 7 years. With multifamily, that's commercial, and multifamily is considered commercial. With multifamily, you can also write the property off over 27.5 years, which is what this table talks about. So you put in that same $1 million, that's what the equity is. You got a 10% cash on cash return, which yielded $100,000, but you got a depreciation tax, which is really roughly $146,000, right? So you went to the bank, you put in $100,000 in your account, your accountant gave you what's called a Schedule K, and you had a depreciation of negative 146,000. So you put in your bank account 100,000, but your CPA says you lost 145,000 and some change, which means you have a carryover negative number to the next year. So that means you can make minimum $46,000 to pay taxes on and still come out even. That's why this is beautiful. Now, there is another type of depreciation called a bonus depreciation. I believe it runs from 2017 and 18 to 2023. Hopefully it'll be extended, where you can depreciate the entire property the first year. So let's say we buy the property for $4 million, we can depreciate the property $4 million the first year. And imagine what that does for your returns. Now, here's another hypothetical situation. You bought the property, we bought the property, we thought it was a great investment, but it didn't make money. It made enough money to pay the mortgage, but it didn't make enough money to give us a return. Guess what? We still have a depreciation tax, which means any other income that you have in other areas, you can use towards that. Now, it gets a little bit more detailed and specific. I believe there's a difference between the monthly dividends that we will pay out versus the taxable event at the sale. The dividends, I believe, will have to go through or be carried over to another passive income. But still, whether the property made money or not, it lowers your taxes or your taxable income, which saves you a ton of money. So go into a little bit more detail with your CPA, or if you would like to, you can speak to our CPA as well as our SEC attorney. I'm sorry. That is the end. So, and it's right at an hour. I did good. So my name is Presley. That's my phone number. That's my email. And that is the website is fibonacci-group.us. You can go there. You can see about the same amount of information that is on here, but the presentation goes into a lot more detail. Again, this is not the full presentation. There are maybe 10 slides that I took out. I wanted to give you guys the basic idea and understanding of what multifamily is, which everybody knows what an apartment is, but how the numbers work and why it makes sense to invest. So from there, like I said, I'm not a Zoom expert. I want to see if there are any questions. And before you have questions, let me figure out how to see if you have questions. Come on, Zoom. All right. So I thought there's normally a chat. All right. So I'll do. Where's my participants thing at? Participants. Actually, you can take yourself off mute if you have a question while I'm trying to figure this rest of this out. Oh, here we go, chat. All right. All right, so LeVar, so they're not a GP and they're still seen as LP, but they guarantee the loan. Yes, you're talking about the key partner, yes.
Yeah, the lead accredited investor.
Mm-hmm. Yep.
Okay.
Any other questions from you, LeVar?
Yeah, how many GPs do you guys have on your offerings typically?
Oh, it depends on the offering, and it depends on the way that we're trying to purchase the property. Currently, we have 6 hedge funds that we deal with.
Okay.
Actually 6 hedge funds and 1 sovereign fund from Dubai. The sovereign fund from Dubai, we have access to, well, their minimum is 50 million as far as funding the deal. So any deal that we are looking at that is at minimum 50 million, they're actually looking at a $35 million deal with us in Austin and Leander. But they like to stay around 50 million. The reason is they have 8 billion to spend before the end of the year. So trying to, buy properties that are in the lower millions, it just, creates more of a headache. The other hedge funds like to say right around 20 million. So it depends. If it's a deal where it's not as clean cut as the hedge funds would like, then we are hustling solo. We are doing what we're doing now. We're first gauging to see if it's going to be a B raise or a C raise. If my rule of thumb, if it's around 8 million or lower, then we can do a B raise. If it's over 8 million or over 10 million, then it's too difficult to do a B raise, because if you're not accredited, then you probably don't have, 100 or more than 100,000 to put in a deal to get to that down payment that we need for the lender. So it depends on the deal, and it depends on how clean it is. And for everybody that is listening, 99.9% of all of the deals that are found are off market. Anybody who starts to do research will probably come across LoopNet. LoopNet is the place where deals go to die. It usually means the seller is asking too much for the property. We get our deals from what's called, it's really more whisper prices, but we get our deals from wholesalers who do all the hard work, or from brokers who have built up relationship with these apartment owners and are reaching out to their investor base and say, hey, I have a client, he's thinking about selling. And it's really, everything is still done the same way, but the difference is you really can't go to any single source to find all these deals other than maybe the broker's website.
Gotcha. How quickly can you guys take a deal down if you're looking at, your overall due diligence period, and you already have the funds accounted for? Then how quickly can you, take it down?
It depends on what your definition of taking down means. Do you mean get to the funding table? Or
Yeah,
get to closing?
for acquisition. Yep.
60 days is usually the minimum for any group. Is extremely difficult to do 30 days, 45 days.
Mm-hmm.
Really just because the appraisals and all that stuff take a really, really, really long time for multifamily.
Mm-hmm.
Or I shouldn't say a long time, but they take longer
Right.
for multifamily. So 60 days is usually a target. Syndicators, we like to try to push it out as far as possible.
Sure.
But now with the market being so hot and your deposit pretty much going hard on day one, once you're in, you're in.
Mm-hmm.
Unless you don't win the bid.
Right. Okay. Do you all have anything right now that you are looking at presenting an offer on?
No. So the most of the deals that are out now are the stabilized versions of what was being bought 2018 and 2019.
Mm-hmm.
There is a ridiculous, I don't remember the number. It was hundreds of or tens of billions of dollars that investors have been putting away because they're thinking this is going to be another 2008. So many people 2008 felt like they missed the boat. So now they're like, okay, let me liquidate everything that I can afford to liquidate and try to catch these deals, which, even in the housing market, we're like, okay, we're waiting for the prices to fall, but they keep going up. Same thing with the stock market. So it's a weird time, not only because we've never been here before, but also because we're dealing with a global issue. But it depends on the deal, and the deals that we get, that we do see, we look for what's called value add, which I'm sure you're
Hmm.
familiar with.
Yeah.
We look for value add, and the value add is not a value add. So when I get the email that says value add 200 units, great, I'm excited. I'm okay. What's the
Right.
price? Good. Price looks good. I'm excited. What's the cap rate? Cap rate seems fair. I'm excited. Then I start looking at the detail. Property was renovated in 2017.
Right.
Well, why are you sending it to me? There's nothing I can do with it. I'm
Yeah,
not
they're trying to disposition
right.
and getting you to acquire it, and your value.
Right.
You guys are value add. So
Which is good for an institutional buyer, for an insurance company, or a hedge fund just trying to keep their returns high, but it's not for individuals like us who are trying to make a larger return.
right. Right. Okay. Good deal.
Nobody else with questions? LeVar is one of our resident experts, so I I
I
knew
see
he would.
I see a couple of my folks on here, Kirkland and Charles.
I appreciate you, Charles.
You know, I'm here. I got 5 children. They're gonna be yelling and screaming. So I don't. um, and again, I understand that this is for investment purposes or
Educational
informational purposes.
purposes.
Educational. There you go. That's the correct terminology. The question comes into me. Of course, return on investment, expectation, initial investment. All of those factors are things where I'm like, what does that look like?
Mm-hmm. So is your question, what does a typical return look like?
Well, no, you've given an example. Expectation when it does come to funding, because you want to cut straight. How
Mm-hmm.
much you could get in? How much is the expectation for the average Joe? Is it 20,000, 50,000? You threw out a few numbers,
Mm-hmm.
but what would be the next phase of this? What would that look like for anyone that was interested in investing?
The actual answer depends on specifically the deal, because you're taking the property price and then I underwrite deals conservatively. So that means the down payment, when I underwrite a deal, I'm underwriting the deal saying that I'm putting down 35%. Had this been 2018, it would have been 20% because that's what lenders are typically lending at. Right now, they're lending at about 30%, but I still underwrite at 35. So that's part
Mhm.
one. Part two is, well, it depends on that down payment size that's going to dictate how much I need to raise. So if I only need to raise 1.5 million, then I can now target non-accredited investors, which is most of America, to raise that money. So that means if my auntie called me and said, "Hey nephew, I want to put in 15,000. That's all I got. That's all I can stand to lose because I understand this is an investment." I can take that because one, it's open to non-accredited investors, and two, what you would really do is get as much as you can get, and then once you reach that number of 35 people, if you still have not reached your down payment goals, then you can just reach out to accredited investors and have them pull up the slack. So it depends. The rule of thumb that I've set is if the deal is over 8 million, then it's only accredited investors only. But there are a lot of deals that I'm running across that are 4 million, 5 million, 6 million, 7 million. And even though that number sounds really, really big, and it is, and the down payment is it is big, that is not large in the multifamily investment space. We are looking at a deal right now that we're probably going to pass, more so because of the character of the seller. But we're looking at a deal right now that's $100 million in California. I think it's Palm City or something like that. Something with desert and palms. Everything is beautiful about the deal, but all money is not good money, and all people who you do business with, you want to look at the character because it's a lot of money, it's a lot of laws involved, and if one party is breaking a law, it might be tragic for everybody involved. So to answer your question, it depends on the deal. If the deal is small enough, then you can take as little as you want.
So Presley, I just thought about this, man. If you're underwriting your deals at 35%, then that means you're borrowing 65%,
Correct.
which is good because, you know, that'll cash flow all day, even in a pretty bad deal.
Mm-hmm.
So at the end of the day, to bring it up to market value, then obviously you will need to do some types of updates. So where does the funding come from for that?
The construction loan inside the construction or rehab loan inside of the loan that you're getting. So the lenders already know that you're buying this property rehab.
Mm-hmm.
And so that's an important question. The even more important question is the lender that I'm dealing with going to release funds for my renovations at a timely manner? Because I can't afford to wait 3 months for a release of funds when my whole scope of renovation time was 3 months.
Right.
So that's a good question. But even more importantly is, am I dealing with the right lender that likes to give out the money real fast? Because, you know, obviously if we're doing a loan for or a down payment of $2 million and the loan is $8 million, we're, you know, doing maybe a 20% down or something like that. The lender has to have that program to understand, look, we're on a limited amount of time, but we're not an institutional buyer. It needs to be fixed up. So it's
I follow you. So what you're looking for is someone that can facilitate the draws quickly too then.
Correct. And let me also give a little bit of detail of that 35%. The reason I underwrite at 35% is because lenders now in the commercial space have what's called COVID guidelines, obviously named. What that means is a lot of lenders want to see 12-month minimum reserve of gross rent, which 99% of the time will kill any deal. Because basically I'm saying if my gross rent is $1 million, that means I need to raise $1 million and not give a return, or be able to raise an extra $1 million and be able to absorb that absence of return. That makes sense? So that 35% is because of the reserve that's being asked for now. On top of, a lot of lenders are, their minimum is 30%. It's very difficult to get a loan in this space for 20% unless you're going conventional, and now you're dealing with
Fannie and Freddie.
Yeah, unless you have a seller that's willing to wait a year to get funded. Okay, I believe I recorded this. I will put this on the YouTube channel. It's obviously the Fibonacci group. If you guys have questions, give me a call. And for SEC purposes, this is obviously educational purposes only.
Informational.
Yeah, I think everybody on here has my contact information. Call me if you have any questions, or if you or somebody else wants more details on how or why to invest. So that is it. I'm wrapping up, and I will talk to everybody later.